It's been an interesting week for central banks, with the RBA and the Bank of Canada both raising interest rates against market expectations. In both cases, they were believed to have paused the tightening cycle. And in the case of Bank of Canada, they actually had paused the tightening cycle for a few meetings. But both of them in the last week have raised interest rates by another 25 basis points. And the reason why that's so interesting is because it's brought into question again whether central banks around the world are going to have to do more. More and more now we're seeing people talk about central banks almost as one entity. If one's raising rates, then others are probably going to follow. When one stops tightening, then others may follow. And yes, that's because they are all fighting similar pressures from inflation. Initially, of course, the commodity price spike last year, but then filtering then through into the economy more broadly, tighter labor markets, enabling higher wage growth, etc. So they do have shared problems, but they also are fighting different pressures. The UK's inflation problem, for example, is still much worse than that of the US. They're also at different stages of the tightening cycle. The European Central Bank only began their tightening cycle in the middle of last year, but the restart of the Bank of Canada tightening cycle in particular has got investors' attention. The Bank of Canada did allude to the fact that the economy performed better than expected in the first quarter, indicating more resilience. The housing market has ticked back as well, suggesting that maybe rates are not tight enough to constrain the economy enough to get inflation back to 2%. And then that was compounded in the first quarter as well by inflation actually ticking higher rather than lower, still remaining close to double the Bank of Canada's target. And that's what warranted the restart of the tightening cycle. And the impact that that's had on interest rate expectations is interesting as well, because traders have gone from not expecting any more rate hikes at all to now expecting one, maybe two more in the cycle over the coming meetings. And that follows obviously the rate hike from the Bank of Canada and the comments that we've now had on the relative imbalance that still exists within the economy that is consistent with getting inflation back to 2%. Other central banks are expected to keep raising rates as well, although expectations have not really changed on the back of this for the Federal Reserve. We can see here that the markets are still pretty convinced that the Fed is going to pause at its next meeting on Wednesday. Now, it's worth noting that there is an important piece of inflation data due 24 hours before, and that could have a big role to play in whether the Fed does choose to pause its tightening cycle for now. And I think the conviction in the markets is driven by comments from a couple of policymakers at the Fed who indicated that this is the time to pause. And if they need to restart the tightening cycle after, once they've given the data more analysis, then they can afford themselves the opportunity to do so after such an aggressive tightening cycle up until this point. But I think that there's still a lot of indicators that may make policymakers uncomfortable. We saw it just from the jobs report alone on Friday. We had an uptick in unemployment, which was a bit of a surprise. We had very modest reduction in wage growth, and participation was higher than expected. But at the same time, jobs growth was more than 300,000. It was almost double what markets were expecting, and really caught people off guard, considering what some of the other economic data points from the US has indicated in terms of hiring intentions in the labor market. And that has to make policymakers uneasy. Like I say, a lot hangs on that inflation data on Tuesday, I think, and then we'll see what markets are expecting going into that meeting. And on that, let's take a look at the dollar CAD chart. And what's really interesting with this chart is the fact that we have seen a lot of movement over the course of the last week. And that's obviously being driven a lot by what we've seen in the US dollar, with it pairing its gains more recently. And of course, that's been exacerbated then by the move by the Bank of Canada, although that move by the Bank of Canada did have a relatively modest effect on the Canadian dollar compared to what you would perhaps expect. The important move actually came prior to the Bank of Canada decision. You can see here there's a cluster of moving averages there. The two purple moving averages, that's the 55 and 89-day simple moving average band. The two red moving averages, that's the 200, 233-day simple moving average band. Now, in this case, the markets have been relatively unresponsive to the 55.89. We've been very choppy over the course of the last 9 months or so, bouncing back and forth above and below that 55.89. But the 200, 233, as you can see, all the way going back to August, we've continually seen the market bounce off those levels and continue to trend high. Well, we've broken below those levels now and closed below those levels on a number of days. So that could be a very bearish development that we've seen in this currency pair. And you can also see the two support levels there, which I think are now going to be key as far as this currency is concerned. 132 and 133, you can see historically that we've seen the price be very responsive to those levels, most notably, as I say, over the course of the last 9 months, where it has been a really important zone of technical support. And if we can see a breakthrough there, then that would be, again, another strong bearish indicator for the dollar CAD pair. A lot of it is going to hang on the data, of course, but when we see these technical breakouts, it does send some strong signals to the markets. And then you'd look at 130 and think that is now an important zone of technical support potentially below. There will be other supports and resistance along the way, but that would be the next real standout level as far as I'm concerned. If you look at the momentum indicators at the bottom following this breakout, the 200, 233-day simple moving averages, yes, we are seeing, for example, a stochastic in oversold territory, but we're not seeing any loss of momentum at this stage. We're still seeing those lower lows being made. You can see on the MACD as well, the momentum indicator at the bottom, the histogram is continuing to add momentum, and the moving averages are continuing to add momentum as well. So there's no signs of trend exhaustion of what we've seen over the course of the last week or so. Of course, that may change over the course of the coming days and weeks. And moving into technical support, I think those momentum indicators can give quite important signals. But ultimately, as I've already alluded to, and I'll allude to again now, the inflation data on Tuesday is going to hold the key both to the Fed rate hike on Wednesday, I believe, but also could send a strong indication as to whether the central bank is really making any progress on that front, which doesn't just lend itself to what's going to happen in the next couple of months at the Fed, but markets still believe that we could see rate cuts later on this year. And if we see stubbornness in the inflation data once more, we may start to see that being pushed back into 2024.